Good morning, everyone, on this Saturday morning. Thank you for joining us in this webinar where we'll be talking about multi asset funds. In the last 7 days, the world has changed a lot. And though we did not intend to launch a multi asset fund NFO during such turbulent times, but such are the times. And today we'll talk about are multi asset funds the right instrument to diversify and invest in such an uncertain times? We'll also talk about should you really be thinking about investing in multi asset funds? And of course, the whole session will have a backdrop of our Capitalmind multi-asset fund NFO, where we'll talk about how we are approaching the multi-asset style of investing. And if you think your investing style aligns with it, maybe give it a shot and apply in the NFO. Today we have on the panel with us Anup Vijay Kumar, who's fund manager for Capitalmind Multi-Asset Fund, and Pratik Jain, who's also the fund manager for Capitalmind Multi-Asset Fund. Both of them will be here with us throughout the session as we take you through. And to start off, we'll talk about the Capitalmind Multi-Asset Fund NFO. We'll run through the presentation. During the presentation, I'll be taking on questions which you have shared in the form and also the questions that you ask in the chat box. So use the YouTube chat box as much as you want, sharing your comments and questions, and we'll take it up as we go. Let's make it an interactive session. Without much ado, over to Anup, and let's start with the conversation around multi-asset.
All right. Thanks, Niyat. Good morning, everyone, and truly appreciate you joining us on a Saturday morning. As Niyat mentioned, we are living in interesting times. I believe crude oil went up about 8 or 9% overnight. So, yeah, that sort of fits in quite perfectly with how we have been thinking about a multi-asset fund and what a truly diversified multi-asset approach really looks like. So that's what we'd like to talk through this morning, and then we're happy to take questions on exactly how is it that we will be investing in the Capitalmind Multi-Asset Allocation Fund. So here's how we've structured this conversation. We start with why multi-asset allocation works. I think intellectually everyone kind of understands how investing across different assets helps, but most people tend to sort of ignore the behavioral or the psychological aspect of what it means when one thing that you hold tends to go up or down a lot. And then we'll get into the specifics of the Capitalmind Multi-Asset Allocation Fund, how the allocation engine works, what it holds, and why our commodity sleeve goes well beyond gold. After that, we'll share some of the backtest results based on which the model has been built, so that you can actually see how the model would have behaved in different market phases, be it the COVID shock, the 2022 supply and inflation scenario, 2025 sideways markets, and then obviously happy to take questions after all of that. So let's just get into that. So the fundamental core value proposition for multi-asset allocation funds is this thing called the behavior gap. This has been well studied, and I'm probably fairly sure that most of us have experienced it in our investing, where the investors' returns tend to lag the returns of the fund that they come from, and this is simply because of our tendency to want to invest in a fund after it has gone up a lot and then exit that same fund when it has fallen. And as a result, if you look even over a long term, investor returns tend to lag the fund that they invest in. Now, this is where a multi-asset allocation fund sort of comes in. It doesn't really eliminate volatility; it tends to compress it, and that compressed volatility is what keeps you from acting against yourself. So think of it as a portfolio that's been designed for the investors we really are. And not the stoic, rational investor we tend to think of ourselves during bull markets. So on the left, you see that red line that is going up and down as it goes up. And the current times are a great example of how markets are behaving to that recent US-Iran war, and all the uncertainty that's now built into equities in general, whether it's global, domestic, where the price of crude is going to go, what's going to happen to precious metals. All of that uncertainty is now playing out. This is when having a diversified sort of an allocation across different assets, which tend to move a little bit differently from each other, really helps kind of stay invested and not have to lose sleep over whether that 40% allocation to gold is now going to come crashing down, or if silver is going to go to zero or something like that, right? So not having to guess what individual assets are going to do is probably the biggest value proposition of multi-asset allocation funds. Now, this is a slide worth spending some time on. What we have here are different macroeconomic scenarios, where different things are happening in the world, and they all have some kind of a combined effect on different asset classes. So think of the demand boom of 2005 to 2008. India's GDP was touching 9%. GDP growth was touching 9%. Credit was doubling. At the same time, inflation was starting to go up, and because of that, RBI was starting to hike. Equities did pretty well during that time frame. Commodities also did particularly well, especially base metals and crude. Gold was all right. Bonds got crushed. Similarly, in the disinflationary expansion period of 2014 to 2016, right? This was sort of what is described as a Goldilocks period for equities, where inflation is under control because oil had fallen from $100 to $30 a barrel, and because of that, RBI had cut rates by more than 150 bips. Equities had their best risk-adjusted run in many years. Gold was not going anywhere at that time, and this is the regime where if you were invested only in equities, you would feel really good, except for what comes after. The supply shock stagflation scenario played out in 2022. Russia had invaded Ukraine. Crude went up and hit $120, very similar to what's happening currently. Equity obviously was down. Inflation had spiked. Gold was pretty stable throughout, and energy commodities surged. So if you had at that point only owned equities or equities and bonds, there was nowhere to hide. The next is the deflationary recession scenario of 2008 2009. Lehman had collapsed. We had what is called as the global financial crisis. India's overnight lending rates went up. The Nifty was down 60% from peak to trough. What worked during that time was like sovereign bonds and gold. Everything else was getting hammered in that kind of a situation. Next is the inflation scare of 2011, 2012. RBI had hiked, I think, 13 times in a single cycle. Growth had come down from over 8% to under 6%. Equities were hammered. Inflation still stayed stubbornly high. So it was really like the worst of all worlds kind of a scenario. Then the liquidity crunch of 2013. This was often called the taper tantrum. The rupee had crashed 15% in 3 months. FII outflows were brutal. RBI was tightening into the weakness. Everything that was risk on was getting hit simultaneously. This is the kind of episode that triggers the largest redemptions. This is where a diversified portfolio gives the courage to kind of keep holding. So the bottom line is this, right? So there are all these different kinds of scenarios that play out at any given point in time, and no single asset thrives in every regime. But a combination tends to work. Combination has something in it that's working. So you own something that's doing reasonably well, or at least not falling as much as some of the other assets, which helps with the whole idea of staying invested for the long term. So now that we know that different assets do well, the why equities question, I'm not going to spend too much time on it. This is fairly well understood. India is one of the strongest growing economies in the world. It is still projected to grow strongly for the next decade at least. And we are even domestically at an interesting point in our GDP per capita, where we are just under $3,000 per capita. And historically, if you look at other economies that have grown from developing to developed, when an economy sort of goes above the $3,000 per capita threshold is when domestic consumption really kicks in a big way, and the domestic equity markets then become much more resilient and sort of not that dependent on outside what's happening in the outside world. So, that's a given, but then we've also seen that equities can be a bumpy ride. I mean, the last 12, 24 months have been evidence that there are times where the markets go nowhere, even as other markets have done well. Uh, but the overall message for equities really is stay the course. It is likely to be the best performing asset overall over the next decade, with some caveats around volatility and periods of underperformance. Next is around commodities. Now, a lot of the conversation around commodities tends to be just about gold, and maybe recently it has added silver to the conversation. But we think that is leaving diversification on the table, which is why we've taken a broader view of commodities in general. We've included base metals and energy in the conversation, and each commodity has its own triggers and cycles. Like copper is driven by electrification, EV adoption. Natural gas spikes during energy shortages. Crude responds to geopolitics like it is doing right now. So each commodity has its own demand drivers, supply constraints, cycle timing. And this is where I think it's very important to take an overall view of what is investable out there. And which is what we've sort of taken into account when thinking about what is it that we're going to consider as part of the commodity basket. Which does not mean that we're going to be investing in a bunch of commodities all at the same time. It's really more about identifying the commodities which are showing the strongest relative strength, and then investing in those. And we'll get into that subsequently. Fixed income, again, India is at an interesting place where our inflation has been consistently now trending closer to the 2% mark. RBI has been cutting, and so we are at an attractive entry point in terms of duration. So the role of fixed income in this portfolio is really to be a shock absorber, to be the stable part of the portfolio. We're not looking at reaching for taking on a lot of risk in the interest of yield. It's more about having fairly stable, reliable debt that can cushion the volatility in the rest of the portfolio, be it equities or commodities. So this quill chart really is about crystallizing what I've been already talking about, which is where you've got different assets which have done well in different years. You can see that there is no one asset that just continues to be at the top or at the bottom. Things tend to change quite a bit year to year. Natural gas was the best performer in 2016 and the worst performer in 2017. Silver returned 95%. This is in USD terms. In 2025, after being flat or negative for 3 years before that. So picking the winner each year requires a foresight, which we don't think anyone has. But owning sort of a diversified slice means you hold something of the winners and never only hold only the losers. So equities overall is a better long-term performer than commodities, but you can see in some years it's the middle, it's the bottom of the pack, which is why having some exposure to other assets like some of these helps. So overall, from why multi-asset allocation funds, where they really help is they kind of take the number of decisions that you need to take off your table. We think of them as fill it, shut it, forget it investments, where the whole aspect of how much to allocate to different assets, when to rebalance from one to the other, and what to hold within each of those assets is now taken off your plate, and it's managed within the fund itself. This combines with the tax efficiency of not having to worry about the tax impact of rebalancing across different funds. So that's about multi-asset allocation.
Anup, while we talked about who this fund is suitable for, I think there are some questions we should take right now. So if you could go to the previous slide, and I'm also getting Deepak Shinoy in. Folks, Deepak Shinoy is our CEO at Capitalmind Mutual Fund, and he has joined us for this webinar. So Deepak, I think I'll redirect this question to you. Is this fund suitable to start a SWP, systematic withdrawal plan, for a retiree?
Okay, I think, Nihit, there are two answers to this. any fund can be used to start an SWP in any case. So the typical point is, let us say I wanted a monthly income for 1 year. I could actually put money into a debt fund, an equity fund, whatever it is, and try to withdraw 1/12 of that money every month, and that will come. That is the thing. The problem with the SWP concept is people assume that the principal amount that you've invested stays protected while I withdraw only the gains every month, right? So that means if I'm expecting, oh, this fund will do 10% a year, then if I put, something like of the order of say 5 lakh rupees, then 10% a year is 50,000. So I should be able to draw about 4,200 rupees or something every month without a problem, right? So I could set up an SWP for that much. The problem with that is when you have a volatile underlying fund and that 5 lakh rupees falls to maybe 4 lakh 50,000 or even 4 lakhs, or 20% fall in equity, for instance, may result in the fact that you're withdrawing money at a lower point. Plus, you're also looking at this and saying, listen, my thought was I'll only withdraw the gains. Now there are losses, and I'm, how does this work? I've lost my principal and so on. So, for both these things, I think you have to be careful about how you think of an SWP. Um, this fund is not designed to be something that protects capital at every point in the time, right? So there will be some ups and some downs. We expect that because of diversification, your ups may not be as high as the ups in say equity or commodities at some point. Your downs may also not be as down as any of those. We've seen this in the past as well. The equities fall 38%. This falls a lot lesser, but it does fall. So there is no concept of principal protection here, right? So there is a little bit of volatility. So if you do want to do a withdrawal plan, many people have thought about it and said, can I do the multi-asset for 2 years? And after 2 years, I start withdrawing every month. There is a risk here that you will be withdrawing during a period of downside volatility and therefore hurting your return. So maybe a better way to structure it is give it a cycle, maybe 2-3 years or so. After that, withdraw enough so that you can last another 3 years. So you can put that money into an arbitrage fund or a liquid fund, and then withdraw from that liquid fund every month for 36 months. And then after 36 months, again draw another 36-month worth, because then you've given the fund enough time to build itself up through ups and downs. And you can appropriately set up your timing so that you do it at a time when there is enough gains in the fund, so that you don't have to withdraw it every month and not see your principal. Your principal could go down, and that is where the usual problem in something like this is, where people do it. Second one is the withdrawal rates. Now the withdrawal rates being very small, it may be okay. So you're talking about 6%, 5% a year, then you might still be okay, because you may not see much of a variation and hurt your compounding. But if you try to do this at 12% a year or something, which is what some people have done with other funds in the past, I would say that is dangerous, because you're not going to get 12% a year guaranteed. You're not even going to get 5 or 6% a year guaranteed, but the withdrawal rate is small enough for you to be okay with this. But at anything larger than that 6% risk-free kind of this thing, you are likely to see a substantially higher impact on your NAV and your AUM, that amount of money you have invested, going forward. So we would generally not recommend that this fund be used as an SWP mechanism until you've reached a point where your comfort level with the profit pool is high enough that you can withdraw a small portion of that profit every year after a period of say 2 to 3 years in the initial part of the fund. And then it may be still better to do this lump sum big 3-year withdrawal once in 3 years, and then use that money through a liquid fund or an arbitrage fund on a monthly basis. Just saying, because I don't want to give the impression here that this is a no downside kind of fund. I'm sure Anup will have more to add here.
No,
No,
absolutely,
so
Deepak.
yeah,
Surely not.
go on it.
Please go. Please go on. Please go.
Cool. So if that is covered, I'm going to get into the specifics of how is it that we have designed this fund, and this will probably address part of some of those earlier questions as well. So the Capitalmind multi-asset allocation fund in a nutshell is 5 asset buckets: equities, precious metals, base metals, energy, and fixed income, with a tactical allocation to REITs and InvITs. each bucket serves a different purpose, and the pitch is really simple. You get exposure to all the assets that matter, managed dynamically in one place. Now, how do we do that? So the Capitalmind multi-asset allocation model, I'm going to call it the CMAF model, operates at two levels. First is the asset allocation layer that determines the allocation to each asset, and then the security selection layer that picks the holdings for each asset within that. Now, the key difference here is that a lot of multi-asset allocation funds are static allocation funds. They have a defined percentage that they're going to invest in equities, commodities, and debt. It could be 60-20-20, it could be 80-10-10, and then they stick with that. They might rebalance annually or something, but they will always come back to that same allocation percentages, irrespective of what the overall scenario is. Our model is dynamic in the sense of even deciding how much to allocate to each asset. So you see there, the equity allocation can range anywhere from 35% to 80%. The commodity allocation and the debt allocation can range between 10 to 55%. This will depend on basically what's happening in the overall macroeconomic scenario, and that's probably one of the key differentiators that we see in our multi-asset allocation fund versus a lot of the others. So coming to the individual assets.
Anup, one question on the engine is that what would be the rebalance frequency across asset classes? Will we be doing a rebalance daily, weekly, or monthly?
So things don't change dramatically from day to day or week to week. The review frequency is monthly, but then the changes are not going to happen like overnight, where it's going to be a gradual shift from one asset to the other as conditions change. So we're not reacting to what happened over 2 days. We are looking at what's happening over a slightly more longer period of time to see whether it's a equity friendly or a commodity friendly or a fixed income friendly environment. And basis that, let's say we are at 70% equities as of today, and then things kind of evolve. That 70 will go to 65 to 60 and so on. It will not go from 70 to 35 overnight. But the idea is to be responsive to a constantly changing macroeconomic environment, whether that's geopolitics, whether that's crude oil, whether that's Indian equities and inflation. All of that should ideally sort of play out into figuring out what that allocation moves towards.
Got it. Thank you.
On the individual assets, right? So equities, we will again follow a quantitative multi-factor model, which will have a large and mid-cap bias, which means we're filtering the universe for fairly liquid stocks, not ensuring there are no micro caps in there, and then to invest on the basis of we're bringing in multiple factors, including momentum, quality, profitability, low volatility, all of that combined to decide what that portfolio is going to look like. In commodities, we're applying what we call a quantitative trend following model in selecting the 2 to 4 strongest commodities out of a universe. Now that current universe stands at 7. This is based on which of the commodities have significant enough liquidity available for us to take positions. That universe we expect will expand as more commodities get traded more frequently on MCX, etc. The commodity sleeve will consist of ETFs, which is for gold and silver, plus exchange traded derivatives on MCX, which basically involves taking positions in, let's say, copper, aluminum, zinc, some of those other commodities. On fixed income, it's going to be sovereign and top rated bonds, duration adjusted based on the rate cycle and the trajectory. But overall, I would say most of the decision making here is rule based, where we're relying on a consistent set of rules to decide how much of what, and then within that, what specifically gets bought in each asset class.
Awesome. So I think Anup, on this slide, where we are talking about different asset classes that we have a bunch of questions. Some of them are in the Google form, which people filled in, and some of them are in the comments. So I think it's a good opportunity that we take these questions right now. First one is about global diversification. Are we going to do that under the equity section? Equities
So
allocation.
we've built in that flexibility into the scheme information document, where we have clearly mentioned that international stocks will be a part of this basket. However, as you might know, because of the RBI limits on how much AMCs can invest overseas, that cap has been reached. So currently, pretty much no one is able to invest overseas. But we have got the allocation made, and as and when that limit is eased, we'll then be able to add international equities to the basket. But yeah, they are part of the investable universe, except that as and when we are actually allowed to do that, we will definitely be doing that.
Got it. So next question is on the commodities sleeve. What is your plan to rotate capital across crude, metals, and equity? Will you stay diversified over long term or increase exposure to a particular theme based on timing?
Yeah. So we talked about over seven commodities on our previous slide. In fact, this is probably a good slide to go to at this point. And this is going to be our basket, but it's not about taking positions in all of them at any given point in time. It is about applying a trend following approach, which is basically identifying the strongest relative commodities at any given point in time, and then take positions in between the top two to four. Again, depends on the nature of which, if many commodities are showing strength, you might see four different commodities in the portfolio. If only one or two are showing strength, then you might see just the one or two. But the idea is to be responsive to the commodities that are showing reasonable amount of strength. And as we've seen in the quilt chart, that keeps changing depending on different situations. And we are also factoring in volatility or recent volatility, and we are penalizing commodities that have shown significant recent volatility to reduce their overall weight in the portfolio. So what might have been a 25 to 30% gold and silver allocation 6 months ago would automatically now come down to closer to a 10-12%, simply because both gold and silver have been showing significantly higher volatility than what their historical data suggests. So at that point, their allocation would come down, and then something else like a zinc or a copper would come in, for example. That will obviously keep changing. But yes, the idea is to be responsive to what has been moving, and to allocate to the stronger trending commodities at any given point in time.
So Anup, a supplement question to the commodity sleeve. Uh, what is the underlying that we will purchase when we invest in metals and crude? Will it be futures? Will it be ETFs? How would we go about it?
So in gold and silver, there are ETFs available. We can take gold and silver positions in through ETFs. For the other commodities, and even for gold and silver, there are commodity derivatives available, which are essentially futures contracts, which get rolled over month to month. So if we have, let's say, if the model says to buy copper, we'll be buying copper futures, and then rolling them over as of each month. So obviously mutual funds are not allowed to take physical settlement of these commodities. It is about, and that's why that exposure is through commodity futures, which are called ETCDs, which trade on the MCX.
So again, on commodities, does our commodity basket have exposure to currency depreciation directly or indirectly?
So because commodities in general they trade globally, which means any currency depreciation automatically features in the price, which means that if the price in USD stays the same, but the INR depreciates against the USD, then that return automatically gets built into the price, because we're trading those commodities in INR. So in one sense, yes, I mean the value prop for commodities in that sense is partly that they kind of partly hedge against currency depreciation. but we are not overtly doing any kind of forex hedging or depreciation. That's not even allowed in multi-asset allocation funds. But to your point, yes, currency depreciation automatically gets sort of cancelled out in the commodity holdings.
Got it. This one's on the equity part. Uh, is our equity allocation focused on a specific market segment like a small cap or a mid cap or a large cap? Or how are we approaching that?
So we've specifically designed it to largely hold large and mid caps. So most of the portfolio, or I would say close to 80%, is going to be large and mid caps. If there might be some small cap exposure, but it's going to be always a very tiny part of the portfolio. We prioritized, stability, or rather risk-adjusted return over just out-and-out return. So we're not taking a lot of aggressive positions in the equity sleeve. It's going to be a fairly stable set of large and mid cap stocks that will be part of the equity sleeve of the portfolio.
Got it. I think the last one on the commodities, with the given volatility in gold and silver, are we going to trade this with some market signals like I think SAR is a technical indicator kind of, or with a long-term positive view? How are we going to trade these commodities?
So we are looking at commodities relative to each other and also factoring in their volatility. So gold and silver have been the relatively stronger commodities out of the basket that we talked about. Out of all of these, gold and silver have been strong pretty much over the last, I would say, 12 months. Gold has been strong for the last 24, 36 months. Silver has been strong for the last year. But then lately, they have gotten a lot more volatile. So as a result, what would happen is their position sizes themselves would come down. And depending on whether they continue to be the stronger commodities out of the lot, they can get replaced with some of the others that you see here. It could be crude, it could be natural gas, copper, aluminum, zinc. So we definitely felt the need to penalize commodities that are showing significantly higher volatility than usual, to make sure that we are not getting into positions like, we will not be doing a 20% allocation to silver at this point. That's just not going to happen given the really elevated volatility that silver is seeing at the moment. So that will get factored into deciding what the commodity basket is going to be. I just don't want to say exactly what commodity, because it's literally changing day on day in terms of what will end up in the portfolio. But we are making sure to factor in the volatility of commodities and deciding what the appropriate position size will be.
Right. I think, Anup, this is one of the most asked questions, and we have been getting it throughout the NFO period. There are a lot of people who are already invested in our FlexiCap fund. And the question is, what would be the overlap of Capitalmind multi-asset allocation fund with Capitalmind FlexiCap fund? And should they consider investing in multi-asset fund if they are already invested in FlexiCap fund? So how should they think about it?
So the first one, the overlap is not going to be that significant, because they both the FlexiCap invest largely with a momentum core with switch to other factors depending on market regime, versus the equity sleeve of the multi-asset is more a multi-factor approach, which is not looking to over-index on any specific factor at any given point in time. So that way, plus the FlexiCap can obviously move across market caps from large, mid, small. So there can be times when the FlexiCap holds 50 or 60% small caps, depending on the market regime. So so the FlexiCap is truly flexible in that nature of where it can go in the market. In the multi-asset, the equity sleeve is going to be largely large and mid caps, and it's not going to be. It's for sure never going to hold a significant amount of small caps in it, simply by the nature of its design. So the overlap is going to be fairly low. To your second question, I think the question is more fundamental on what is the overall asset allocation requirement of the investor. Let's say you're the kind who's very tuned into exactly how much you want to invest across different assets. You know exactly how much to put in equities, debt, commodities, and you've been managing that yourself and choosing when to rebalance between across multiple asset classes. Then you stay with the FlexiCap, and you don't need to really think about a multi-asset kind of a situation. On the other hand, if you're an investor who values simplicity and not having to make too many decisions around how much to put where in which asset class, then the multi-asset sort of fills that need, where it's one fund where you sort of invest in, be it lump sum or SIP, and then not have to worry about whether to add gold, whether to add silver, whether to reduce copper, whether to reduce equity exposure or not. All of that kind of gets taken care of in one fund.
Got it. I think we have taken a lot of questions, Anup. I think we can move on with the presentation and we'll take more questions on the way.
So we've talked about the layer one of asset allocation. We've talked about how the fund will buy securities within each asset. One other aspect that is important to highlight here is the tax efficiency part of a fund of this nature, because we talked about how dynamically it's going to increase and decrease allocation across equities, commodities, and debt. The good thing is none of those changes result in a tax incidence for the investor. All of that is, as long as you are invested within the fund, there is no tax payable, as opposed to if you were to do it standalone. If you had a standalone equity fund and a debt fund and a commodity fund, and you were to reduce and increase exposure, each thing would result in some kind of a tax incidence that you would then need to figure out whether it's short term, whether it's long term, whether it's slab rate. Here, all of that sort of stays, I would say, protected in one structure, and it will have equity taxation as long as the holding period is more than 2 years. So that sort of can make life a lot easier in terms of figuring out taxes to be paid and not paid, and when and how much and all of that. It's very simple equity taxation as long as holding period is 2 years or more. So summarizing all of that, it's really about a core all-in-one allocation. You understand the importance of diversification without having to juggle equity, debt, commodity, all of that separately. Have at least a 3-year horizon. I would really recommend 5 or more. And you prefer a hands-off approach without the stress of chasing markets. It's suitable for both SIPs or lump sum. And there is that tax advantage of not having to pay tax each time there is a rebalance. And overall, I would think, it should give you over the long term a smoother investment journey than being invested in any one asset class altogether. And the portfolio itself adapts to different market conditions. It's a rules-based approach, like we've already discussed. So if all of that sort of makes sense, then this might be the right fund to kind of consider for the long term.
Awesome. Before we move ahead, and this is probably one of the most interesting sections of the presentation where we put numbers to our philosophy. So we'll be showing how the backtest looks and what we infer from it and what does it indicate. But before we go there, few questions about investing in the asset allocation fund, and that's why I've got Deepak back in again from the green room. So Deepak, the question is, Shaurya, I guess I'm getting the name right. Shaurya is asking, I do my own asset allocation. So can I transition all my holdings into this fund eventually? Like gradually, is this one fund that can solve all of my asset allocation problems and requirements?
So, I mean, can you? Yes, of course. But here is, I think, should you is a different, is this, because when you have funds already, one of the problems that you will have into moving such things into this fund would be a taxation, because we've already held a bunch of assets. You want to figure out if this is the right time to move it. Second, the problems that you're facing with doing your own asset allocation, because apart from taxation, there's also decision making on how much should I put into each asset, and then which how much should I rebalance at which period, and so on, which kind of adds a layer of decision making on a monthly, quarterly basis, or even an annual basis into your and then redirecting your SIPs appropriately, because gold is too much, let me stop the gold SIP and move it into the equity SIP, and all these decisions and the transactions involved in doing that has a certain amount of pain associated with it. So if you feel that this is something that you want to transition over to a fund manager like us, and then that would be a place where you might say, okay, listen, we want to do this in one place and leave it, and I will get multiple assets allocated to me. I will have a fund manager choose which asset to allocate how much to at what point in time, and also that you're aware and understand our model of doing this quantitatively rather than deciding just by say in a different way. This approach may help you. One of the other things I would always say is, because in general you might want to have, say, one or two multi-asset funds, even if you want to do this with slightly different approaches. We are a different approach from the others. There may be somebody else with a different approach. That would make sense for you to do this. It would be great to have to manage this and take the pain off of your hands if that is something that is stopping you at some point from enjoying life a little better, because you're having to deal with all these taxation / asset allocation decision making all of the time. But again, it depends on who you are and your individual situation. I would just say consider all of this before doing it, and of course we would love to do it.
There's one more question, Deepak, and this is around. So we are setting up a family office with a portfolio size something. Can this be a meaningful allocation? And can we start with, say, a 5 crore and scale up? So this more specific in terms of the question, but probably interesting for others as a case study to know and understand how they can approach this.
Yes, I mean, firstly, I don't want to give any advice here because I don't know the specific situations and the goals. But if, for instance, the goal is to build long-term wealth with a little bit of allocation to reduced volatility, and now you have a family office, means this money is unlikely to be needed for the short term. I'm assuming it's a long-term allocation. There may be some requirement saying, listen, some part of it should go into something that is extremely high risk. It could be AIFs, it could be equity directly, it could be small caps, whatever it is, right? There's some part of it that needs to be stable, but give you slightly higher than debt returns in the short term, kind of fixed deposit kind of returns in the long term. But there is some volatility that is acceptable, not as much as equity. And there's one portion that may be more towards, I want to save this money, so it will be liquid, arbitrage, debt fund. So every family office will probably have allocations to all three buckets. We will fall in the middle bucket. Some family offices choose to have a larger middle bucket because they don't want the extreme volatility on both ends and on up and down, and they also don't want the extremely low risk-free rates that are available otherwise. So in that middle bucket is where we would fit in the multi-asset allocation fund, and that's where you could allocate, watch us, see our performance, see us for over a period of time, and then increase allocations over a period of time, and see whether we're matching the promise of lower volatility and yet longer term returns that are commensurate with this kind of an approach. And we would generally recommend that, because you're talking of relatively small numbers, 10% of a portfolio, it will be perfectly fine to allocate it without you're not over concentrating on one thing, on one fund, and that would be a good way to kind of position yourself. I think this is the way your family office is structured. If it is an extremely high risk, high reward kind of a family office, then this is not that high risk, high reward portfolio. It's that middle bucket where you want some stability, not as much volatility, and you do want better the longer term returns than pure fixed income. That's where I think this kind of a fund would meet those requirements. I hope this has helped, but it's just about structuring and thinking of where you are.
Right. Awesome. Thanks, Deepak. I think, Anup, we can now dig into the model backtest results and what we infer from them.
Sure. So this is basically a representation of the whole framework that we talked about earlier, how we decide allocation across different asset classes, how we allocate within those asset classes. If we were to apply those rules consistently over the last 8 years, what would have happened? So it is a simulation of reality. It is not really a representation of reality. So you should always look at any backtest with a pinch of salt, because you will never see a bad backtest. but it does sort of give you some sense of what the philosophical underpinnings of the portfolio, how have they played out in different scenarios. Just helps you kind of get a sense of what to expect going forward. So 1 lakh invested in the model grew to 4.5 lakhs over from 2017 to 2025. The benchmark that we picked here, which is again a multi-asset benchmark, would have reached 2.6 lakhs. So obviously the return number looks pretty good, but that is not really the headline as much. It is the fact that if you compare it with, let's say, the Nifty 500 over that same time period, it gives you a comparable return for a significantly lower volatility, and that's really the key value proposition of a multi-asset allocation type of an approach. So instead of seeing a 38% dip at some point, this portfolio would have fallen 15%. And that's a significant difference. I mean, because of the math of a 50% drawdown needs a more than 100% rebound to just come back to break even, right? So that is where really a multi-asset kind of an approach shines, not because it's going to give you better returns than the Nifty 500. I would be very surprised to see a multi-asset allocation fund do better than the Nifty over a 10 plus year period, simply because in the recent past we've seen gold run up a lot, and that's kind of taken most multi-asset allocation fund returns. It's making those returns look significantly better. But traditionally, gold return tends to just about maybe match, if not be a little bit lower than equities at lower volatility, and that's what helps a multi-asset allocation portfolio. This chart is a quarterly allocation table of the different commodities that we've spoken about, and to where they would have bought what kind of commodities in different time frames. So at the bottom is obviously the total allocation itself to commodities. So that number itself, you can see it changes significantly, as low as 15% at some times and as high as 50% at others. And then within that, you can see that it would have held different commodities at different points in time. You can see a pretty consistent allocation to gold, and it's a result of the fact that gold has been one of the most stable and consistently rising commodities when you look at the overall universe. But that has not always been the case. There have been phases where gold has struggled. It has shown higher volatility, which is when some of the other commodities would have played a part in the portfolio. So you've got aluminium at different points, copper, zinc, even crude oil and natural gas, which tend to be fairly volatile, have come into the portfolio at different points in time.
So on this slide is about how we'll go through different commodities, and there are numbers there on the slide, but still I'll take this question, Anup, and you can probably read through the numbers. So what has been the average holding period of each commodity? How much should we read into this holding period? And how does this evolve over time?
So the average holding period of any commodity in the portfolio has been roughly between 5 and 6 months. That it's been in the portfolio before kind of making way for something else. Again, the idea is to be responsive. Commodities can be significantly volatile during certain phases, as they are now, which means that it's important to be able to respond to what is unfolding. So gold and silver would have been in the commodity leading up to now, but we would be responding to the elevated volatility, especially that silver has seen, to kind of make sure that does not become a big part of the portfolio and add volatility instead of really lowering the overall volatility of the portfolio.
Got it. There's one more question that has popped up. So Aditya is asking, Capitalmind has been predominantly rule-based, model-driven, and so has there been instances of manual override of models? So when do we take an exception to what the model is saying, and how do we go about it?
So the way I describe our style of investing is it is systematic, it is rule-based with a human in the loop. Because things keep happening, no model is perfect, and there can be inputs which are not part of the model which are happening in the world, and which is where it does need a human judgment override at different points in time. So are there or have there been instances where we have chosen to override the model? Yes, not very frequent, but they do happen. Both from a point of view of whether to add something to the portfolio or not, be it be it an equity or a commodity, and if yes, how much. The model might say, well, you can go in 20% into X, but everything about what is happening externally might suggest that that might be a high risk position. At which point we might choose to reduce the amount of allocation we do.
Got it. I think, Anup, we can proceed with the backtest results.
All right. So this stack chart is about overall what the split across various assets look like. We broke it down into instead of just having one commodity line, we broke it down into base metals, precious metals, and fossil fuels. By fossil fuels, I'm talking about crude oil and natural gas, just to show how much of each of those would have been in the portfolio at different points in time over the course of the backtest. So the purple that you see is obviously equities, which tends to be reasonably high in the portfolio, followed by precious metals. But then you also see, base metals, fossil fuels, and then the fixed income allocation tends to go up in times of significant market strife, where risk on assets are struggling, is when you'll see more of a pivot towards fixed income to sort of keep the portfolio fairly stable. Then there are, I would say, these three panels are really about specific time periods in the not too distant past, where and what's happened to the model, and it sort of helps to kind of get a sense of what happens in when equities are struggling versus when equities are having a great time. 2020, there was obviously the big COVID crash followed by the big recovery. Leading in, equities were already fairly weak, due to which, because of which equity allocation was, reasonably, I would say, around the 50-60% mark, and there were other commodities in there which helped cushion the fall. And then, it was part of the recovery, and it did reasonably well in that kind of a scenario. 2021 was an out and out bull market for equities. Everything was going up, especially small caps. At that point in time as well, you can see it. The model would have trailed the Nifty 500, which is to be expected, most of the time. But it still participated reasonably well in that market, in that bull market, primarily because it had reasonable allocation to equities. But then even some of the other commodities and other assets it had did reasonably well. So it gives you reasonable performance in an out and out bull market, but you would expect to underperform a pure equity-led allocation. 2025, which is fairly recent, has been very flat for equities in general, which is where the commodity allocation, especially to gold and silver, would have helped the model, which is where you can see that it would have done reasonably well. Again, think of these as sort of indicators of what to expect in different market scenarios. It is going to trail in some, it is going to lead in some, but overall, it's going to, the target, the objective is for it to have slightly lower volatility than if you were just invested in some of the most volatile asset classes, 100%. Lastly, coming back to that tax efficiency point, right? So the model essentially would have had at least 35% allocation to equities at any point in time. This ensures that it qualifies for LTCG taxation after 2 years of holding. So we will ensure that is always the case, so that there is no uncertainty in your mind about what is the taxation that will be applicable as and when I redeem this fund. It's always going to be equity taxation as long as the holding period is 2 years or more. So that's really the what I wanted to cover in terms of the model backtest. Maybe Deepak can talk through for folks who are new to Capitalmind. Maybe give them a quick brief about Capitalmind, what we've been up to, and where we've come from, because we are a reasonably new AMC in that sense, but not new to investment management per se.
Thanks, Anup. Yes, we've been around now about 11 and a half years. Started in 2014, primarily in investment research. In 2017, we started the portfolio management service, Capitalmind Wealth portfolio management service, and the PMS has now got about 2,000 crores, roughly 1,900 odd crores in assets under management. And the AMC, which is the Capitalmind Mutual, which runs the Capitalmind Mutual Fund, got its license last year in April, and we launched the first fund, the Capitalmind Flexi Cap Fund, in July of 2025. It's about 6 and 7 months now, and I would encourage you to check performance and how we've done in the past. Both of of the mutual fund itself, which is the Flexi Cap Fund. We also have a liquid fund that was started in November, managed by Prateek. Anup manages the Flexi Cap Fund, and both of them also now manage the multi-asset fund. Now, our history in investment management has come from a large amount of data-led, data-backed, evidence-backed research. We use a lot of technology internally to backtest and understand our strategies. And because we've done this, practically before, so our backtests include a lot of things which perhaps aren't easily usable in backtest software that is available globally. So we use India has a lot of very specific things, like when you sell today, you cannot buy today itself. You have to wait till tomorrow when the money comes, and only then can you buy. In fact, earlier it used to be you have to wait 2 days. Now it's T+1 settlement, so you get money in the next day. We also have different transaction costs, STT. We have a different impact cost. Liquidity can change on a regular basis. So a lot of the testing, a lot of the thought process goes around understanding how specifics of the Indian market itself, and then liquidity constraints and impact cost constraints, slippages, and so on. Apart from that, of course, we write a lot, so we do have a lot of content that's available. Soon, all of it will be consolidated on the Capitalmind Mutual Fund website and the capitalmind.in, which is the parents' website. You might see us, on Twitter. You will see us on some of the TV channels. We have a podcast with about 2 million downloads. There is our podcast now is moved to video, so we're a video format as well. It used to be audio. There are more than 5,000 articles on investing written. I've been writing on it for more than 20 years, but as a company, we've had a substantial amount of content coming out, and you'll see us in many places. I think more important point is we are asset managers that are running a mutual fund, in the sense that we actually are very core. Investing is our core here, and we understand what it is. A lot of our own money and plus our company's money sits in our own mutual fund assets. We also truly believe in long-term investing, in the sense of dealing with different types of volatility. Of course, the company started in 2014, so it hasn't seen the 2008 crisis, but I think each of us individually has. And then we've also seen the 2020 crisis running. Anup was there, watching the markets bleed in horror in the 2020 crisis, and then the massive recovery that happened. The ups and downs, we deal with the emotional constraints of markets all the time, not just of our investors, but also of us. So and we're truly at heart people who think in your favor. So you'll never find us blindly telling you to just blindly invest in all our products. In fact, most of the time, if we think things are too hot, we'll probably tell you not to invest in our products. So excuse us for that. But yeah, would love to take any questions. We have 4 funds. 2 are already in existence. Flexi Cap is about 370 odd crores. Very, very decent performance, if I may say so. Even in the last 6 months, top decile performance. And then we have the liquid fund, which is also relatively short term. We've only started in end of November, so about 3 months in, and the performance there is also very decent. Though liquid funds you don't generally buy for performance, we've kept the expense ratios there very, very low, so that we can we can deliver you better performance in the liquid fund kind of category. And the multi-asset and arbitrage are ongoing right now. Arbitrage is essentially, for most of you, a lot more tax efficient in terms of parking short-term capital, because even short-term capital is taxed only at 20%, whereas almost all other options that are relatively low risk, you get taxed at 30%. So it takes away a fairly large chunk of your returns from there. And then the second part is, of course, you have a we have the multi-asset allocation fund. We've been talking about it. Differentiations clearly being going beyond gold and silver, and dynamic allocations across various categories of asset classes, including within equities. I think we talked about equities. We'll talk about international equities as well. Different forms of commodities, different areas of fixed income as well. And then the tax efficiency of the rebalancing and holding after 2 years, that gives you a better post-tax return, at least as of current law. So this is where we are. Uh,
Yep.
Quick note
Thanks,
about us.
Deepak. Thanks, Deepak, for concluding this session. And now we'll take few questions that we have got on the form and in the chat. So I'll just put them across one by one. So whoever of you wants to chip in can answer them. But first, I'll ask Prateek two questions on fixed income that are there in the form. So, Pratik, in the Capitalmind multi-asset allocation fund, how are you thinking about approaching the fixed income allocation?
Okay. So hi everyone. Yeah. So fixed income allocation in this multi-asset fund is going to be a avenue of stability. So most of the time we are going to invest in sovereign assets, and investing in sovereign assets will also help us because those assets can be used for margin purpose for the commodities or maybe equities, whatever we are taking in the futures form. Secondly, we will target accrual as a strategy, which simply means we will not take duration risk. We will not go and buy 10-year, 15-year, 20-year kind of papers. We are mostly going to focus up to 3 years of the curve. And over there also top-notch companies, AAA, AA plus kind of companies, which is giving us positive returns month on month with a very low volatility. If you see, fixed income will be true diversifier in this fund because both commodities as well as equities can be very volatile on month-to-month basis. But fixed income should anchor this fund and reduce the volatility overall.
So when we are allocating in fixed income, as you said, we'll have an accumulation strategy. Then what are your views on interest rates? Do you see a rate cut coming? How do you see the yields going forward? And how would you play that?
Okay. So right now, if you see the last year, RBI has already cut rates by 125 bips, and current repo rate is around about 5 quarter. Going forward, inflation I think is already bottomed out. Last year, inflation was very low, almost like 27 bips, 0.27, and now it's moving up. Even if you see RBI expectations and economics expectation, people are expecting inflation to move up to 4%, which simply means at the current repo rate of 5 quarter, we still have a very big 125 bips real rate over the inflation. And hence the fixed income is adding to the purchasing power and not taking it away. Also, if you see the recent turmoil, so the crude prices are going up, but if they go up for a month and they go back to whatever 70 levels, I don't think so it's going to hurt long-term inflation in India. But if the war scenario goes on for 3 months, 6 months, at that point of time, inflation can be a worry. So my view is we are in a scenario of long pause, and in this long pause, RBI is going to give lots of liquidity into system. In fact, if you see this financial year, whatever is the net supply of Government of India security, out of that 60% is absorbed by RBI themselves. So that kind of liquidity infusion is happening in the system, and this will continue, which simply means your overnight rates are going to be very low and your 1 year kind of rates are going to be higher, and there are going to be opportunities of trades on this curve, and we are going to essentially capture those opportunities over here.
Got it. Thanks, Pratik. I think we should take one question which has come to Deepak in his DMs. And when we were probably planning for the multi-asset allocation fund, we thought that we'll be launching this fund when there is pink bloom in Bangalore and everything is looking beautiful and calm and nice. But now this war has broken out, and so the Israel-Iran-US conflict is going on. How does that affect the fund strategy? Deepak and Anup, anybody of you can pick this up.
The idea of the fund was to be able to respond to whatever happens. We know that some things happen and gold goes up, some things happen, crude goes up, and that was the whole point of designing this strategy. Where when we started thinking about it, it should be that the strategy can't be reliant on hoping that okay, let's buy a bunch of gold and hope that it keeps going up. That was, in fact, our strategy had to be more responsible and flexible, assuming that what if gold goes nowhere for the next 3 years, silver goes nowhere for the next 3 years, what would a multi-asset allocation fund do? And that's where it is. It has the flexibility of having a dynamic allocation across different asset classes and different commodities themselves in the commodity sleeve. So ideally, this is a great test case for a strategy like ours, which should do well irrespective of us not having foreseen the US-Iran war going in when we were actually deciding on launching this fund.
Yeah, I mean, it's kind of interesting. With gold crude is at what, 93 today. It was 68 when we launched the fund, so it's kind of gone up tremendously. And it's not even like we can say with confidence that we would own crude before this, right? So it has to have formed a trend before we would have picked it up. But the point about a multi-asset fund is exactly this, in the sense that when you're worried that equities will fall, but something else is going up, and then there is that balance that happens because you've got lesser allocations as a percentage of your assets to any single asset class. You're not 100% equity, you're not 100% commodities or something like that. And then within the commodities, something's going up, something's going down. Maybe gold and silver are okay, but they're not reacting as much as they earlier would to a crisis like this. But crude is. On the other hand, equities are finding, places to kind of hide and slow down and perhaps change their trajectory. There's a lot of other things also happening in the private credit space in the world. There's a lot of fear of defaults or redemptions that are happening in that place. That's another small mini crisis kind of brewing in the financial space. There is perhaps more things happening around on trade, because you don't know what's going to happen with how trade once this, apart from the fact that crude prices are going up. There's also a supply shock. There's a change. Korean markets are down right now because they're afraid they may not have the energy to run all the RAM manufacturing plants that have given them so much growth in the last few months. But at the same time, downstream there's an impact on will this happen, will that happen. I think there's always going to be some layer of panic at some points in any given year. If you remember Brexit that happened, I don't know, 6, 7 years, 8 years ago, India, which is completely unrelated to Britain. We are the original Brexit, which happened in 1947, and that was a different time altogether. But why does Britain exiting the EU have to take India down 6%? That's again a question that we will not be able to ever answer. But the point over here is, even at that time when equities went down, something else went up. It kind of balanced it out. Even during the COVID crisis, when equities was going down, bonds were going down. I think pretty much every asset, crude was turning negative. It turned negative in April of 2020, but gold was going up. So there is some balancing factor that kind of works. I think what's happened right now, and this is an important thing to understand, is that it's top of mind right now because of its immediate impact on whatever we are doing right now and so on. But I think as all wars go, there is a layer of extreme times, and then there's a layer of back to normalcy that happens also. Now, if it is a world war that lasted 6 years and 10 years and everybody in the whole world got involved, that would be a different ballgame. That would be escalation of magnitudes which we are not currently, I don't think any economy is prepared for. But I think at some level, if there is going to be a layer of extreme behavior, and then a layer of normalcy that comes in towards the end. And this happened in COVID as well. It looked like the whole world was break apart. Will we ever be able to get out of our houses? Will children ever be able to go back to school? We will work from home forever. All those statements happened in that first 2 or 3 months. And then what happened after that, and we look back about it and we say, okay, well, you know what? Maybe we were overreacting to the long-term financial impact of any of this stuff. I think that stability is what brings in assets to kind of come back to normalcy at over a period of time. And this is the time when you need a multi-asset fund to help you invest even through these abnormal times, because it is the investing through the abnormal times that makes you long-term wealth. So it's not that there's no panics. The point is the panic in the world should not cause you to panic and stop your long-term investment strategies. Of course, it's different if you're directly involved. If there was a point where you were in that region, then of course your investing behavior will change. But at some point, we want to remove that investing behavior panic from people who are relatively insulated. Bangalore is still having the pink bloom. I have the February sneezes, so that is still on. So I think some things about that may eventually come back to stability, even in the financial business. So I think, like what Anup said, it's geared towards handling this kind of a situation, though we will never be able to predict what kind of a situation happens next. The fact that you're diversified, you have your eggs in different baskets, is what makes your portfolio a little more stable.
Got it. There's also one more question. There are two questions. So there is one thing that people keep asking: what are your views on crypto? Will you invest in crypto? Of course, that is not allowed, so we can't do it. But I think the broader question is: will we include more asset classes or asset types into our universe as they come about, or as the fund evolves? Are we open to more asset classes, or have we fixed our basket and we'll just stick with it?
So one key part of our investment philosophy is that it's never a once and done kind of an approach. We are constantly looking to iterate and see what are the opportunities for improvement. And from a commodity perspective, I'd love to see many more commodities available for us to invest in. Like I'd love to see some of plutonium and platinum and many other commodities which are currently not available to us here in India to take positions in. As and when that happens, we will definitely look at expanding that basket. But obviously, after having done the requisite analysis, looking at what their behavior has been historically, and then choosing whether or not they make sense in a portfolio like ours.
Yeah.
Also,
And
on
also
the
remember,
commodities. Yeah, please go ahead, Deepak.
yeah, also remember that specifically SEBI restricts what we can invest in. So if we were to find a new asset class that SEBI does not have any provision to call it, so for instance, international equity is equity. It's not a different asset class, though it may behave uncorrelated to Indian equity for a while. There is, according to SEBI, it's still equity. REITs are equity, even though they may not have the same behavior as equity per se. The classification is still equity. So unless there's like a fourth asset class that's created, like Bitcoin or crypto or something like that, we can't invest in any of those. So I think we're restricted by those. But I think we should be open. I mean, the idea is the world changes. There are interesting, things to invest in, and I don't think we will want to restrict ourselves, especially in a multi-asset allocation fund, from investing in anything other than, like we don't right now do high risk credit. We have not decided to do anything in small caps and so on. But that's a small refinement of inter-strategy approach. But otherwise, anything new that is interesting in long term, I think you should always assume that we want to do it.
Right. So two more questions, folks, before I let you go. First is probably for Anup, that if you feel that equity or commodity is likely to be range bound, so are you allowed to take covered call strategy? Broadly, are you allowed to hedge, and how do you look at hedging or moving to cash in this fund?
So firstly, it's not a function of how I feel. It is a function of how the model sort of tells us what is the ideal allocation. And if the model says that equities are completely weak and take the absolute minimum kind of allocation to it. So one is we can go down to 35% equity allocation. Within that 35%, we can hedge our positions, like you mentioned. So we can take, we can sort of sell futures on those positions so that we are net not exposed to equities at all. So theoretically, we can go down to zero. But do I see that happening unless there is an actual world war breaking out? I don't see that happening. But yes, can we reduce equity exposure substantially by taking arbitrage positions? Yes, we can do that.
Got it. And the last one, and probably Deepak, you can take this up. What are the advantages of investing in an NFO, uh, and compared to investing when the NFO reopens and you can just buy it on that day?
Oh, of course. I mean, see, for instance, a lot of you will want to do SIPs. You might only do one installment of the SIP in the NFO, and the remaining can come after, right? There's no real major differentiation other than the fact that since it's a new fund offer, it has to be open during this time. I think the main aspect of all of this is for us to be able to collect enough capital to deploy in all these instruments that we talked about. Also, for it as an ongoing strategy to keep evolving as the market changes and grows. The NFO itself provides you no major differentiation, and it's closing next Monday, so it's literally 3 days, and if you invest now, in a few days after that, the units will become open for subscription, so you could buy it after that as well. There is no financial difference, in the sense there's no extra cost or thing that you pay afterwards. But an NFO will give you just an entry point at a time when we are out here telling you about the strategy. So you have the ability to kind of talk to us, invest. Afterwards, we will do these things regularly, but the amount of detail you're getting here is probably something that is unique to an NFO, because we're here to understand what your questions might be, and answer them in all formats. And then later it may be more spaced out. But honestly speaking, the NFO versus something else is not there. But we'd love to have you as early investors to support us, and then for us to help build your long-term wealth. The NAV starts at 10 rupees for the NFO investor, but after that it's always market led. It could be higher, it could be lower. And our main aim is to bring more awareness of this product and the differentiations it offers and the approach it takes, so that you can make your decisions and then at least start your investing process with us.
Okay, so I think on that note, on the note of NFO, we can conclude this session. Thanks to our panelists, Deepak, Anup, and Pratik for joining in. And a bigger thank you for all of you, the audience, for joining in on a Saturday morning. We hope this session was worth it. Maybe a few insights were there that may help you invest better. And maybe our presentation of our multi-asset fund, NFO, will help you probably consider this fund as part of your portfolio. So once again, thanks everyone for joining in. We hope to do more of these webinars and will of course send you the invites. So please join in. And if you have any questions, you can always reach out to us via email, through our call center, on Twitter, or any social media where you see us on. We reply to all emails and comments, and we are very happy to get your feedback and to help you invest better. Thanks from the Capitalmind team, and we'll conclude this session. Thank you.
Thank you so much.
Thank you.
Thank you.